Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark discusses interest rates. Dr. Marc Faber from the website gloomboomdoom.com discusses whether diversification or concentrating on one economic area is more likely to make you rich. And Mackey Research's Payton Nyquvest will wrap up Canada's junior markets for the week. We talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
We're talking with Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Well, glad to be with you, and it was an interesting week that we had this week, Jim.
The Bank of Canada kept its interest rate at 0.5%. What else is happening with interest rates?
Well, we might have official rates not moving anywhere, in Europe as well, everybody holding over there. But the talk is that there's a 40% chance now of a more imminent rate hike in the U.S. coming sometime maybe as early as this month, September, rather than out into December. Now, we also have to remember that the Fed is not in a position where they are obligated to change only at their meeting dates. They can change any time that they want to if they see it as a necessary item. But the fact is that with that news that sort of hit the tape on Friday morning, the bond market took a big hit, down now at the lowest levels that we've seen since June, so that's clearly breaking down. And with that, it means that the U.S. dollar starts to look more favorable for people who are looking to place money in currency. So U.S. dollar up about 30-odd points on the day here, the index at 95.35. It then also has an impact over into the metals market, so we get a bit of the hit on the gold market. So in general, though, we take a look at the bond market. It was at excessive levels in the summer. That second week of July, we had these big signals from our work suggesting that an exhaustion high was in place and to be looking for a good hard break. We had pieces come together that we've seen 9 times in the last 30 or 40 years, where the short term, the intermediate term all come into play. Looking for the hard break. Usually the first part of it takes you down to the 20-week average. And as of this week, 9 weeks from the top, we've got exactly where we had as our interim target. So would expect to see maybe a bit of a bounce here in the next couple of weeks. But in general, interest rates appear to have bottomed. The 10-year yield on the U.S. Is already starting to go up significantly. We've gone from a 137 yield up to 167, and that low at 137 was a retest of what we saw back in 2012 before we got into 2013, and we had the taper coming from the Fed in terms of rates there and on the bond market. So from my perspective, yield at 167 right now probably has a easy move through 2%. Wouldn't be at all surprised that you get up around 2.5%. That in turn is going to have some pressures on a lot of the items.
How does this affect the equity markets?
Well, equity market generally, when you've got higher rates, it's because the economy is getting stronger and earnings are getting stronger. So in reality, what we should see here is an initial break on equities just because of that concern that rates might be starting up. But I'm looking at a 5 to 7% break as the norm. That's where the support should start to kick in. We're down about 3% off the highs right now, so we're probably, maybe close to halfway through the break. We'll see what happens when we get down into the S&P, maybe around the 2070 level. That'll be a key support area to be taking a look at, and see what kind of a bounce we can get from there, especially because we've had, 40 or 45 days here with less than 1% moves in the market. And we really blew through that on Friday. We're down over 2% in the U.S. equity markets. So that move outside of that trading range, the anxiety was high, volatility was low, and we've got to the point where, everybody's going to run for the hills for probably a week or so, and then we'll see how the stability kicks in.
If U.S. interest rates go up, what will that do to the Canadian dollar?
Well, if rates are going up in both sides of the border, it doesn't matter. If rates are going up in the States relative to Canada, then that's going to hurt us. The other aspect here is that the oil market, which had a really nice move from 43 up to about $48 this week on some very, very big declines. I think it was record decline in inventories. That's probably due to settle back a little bit. And I'm looking for still that upside bias in oil. So that's going to be supportive as far as the Canadian dollar is concerned.
Ross, thanks for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, Dr. Marc Faber next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Dr. Marc Faber from gloomboomdoom.com. He's speaking to us from Thailand. Marc, welcome back to This Week in Money.
Thank you very much for having me. Thank you.
We have a lot to talk about today. First of all, tell us about your Gloom, Boom, and Doom report and how people can find out more about it.
Well, the best is to go to my website, gloomboomdoom.com, and I have two reports, the Gloom, Boom, and Doom report, which is sent out by mail and is a printed edition, and then I have the website report. Both of them can be subscribed through gloomboomdoom.com.
Marc, when you're looking at markets, do you look at cycles and or the fundamentals, and why?
Well, I look at everything. Political events, social developments, economic statistics, and obviously I follow the movement of stock, bond, commodity, precious metals, real estate prices very closely around the world, and of course also currencies. So you have to take, when you make investment decisions, many different factors into consideration.
We hear that diversification is the safest way to invest, but does diversification work if you want to become ultra rich?
Yes. I think we have to distinguish between, say, a top tennis player and the average tennis player. The top tennis player, he will play an aggressive tennis to win. The average tennis player is better off playing a game where he doesn't make a lot of mistakes. And there are some investors that have an edge. Not always, but frequently. These are people, they know a market particularly well, either because they're politically connected or because they follow an industry very closely, or because they invest only in a local market where they know the companies better than, say, foreign investors. But the typical investor is someone who has a job, has some money, and then wants to preserve the capital he's accumulated through hard work and savings. And for that person, my suggestion is that diversification is the best method to go about. It's not necessarily in every year the most profitable way to invest, but for the average investor, it will provide him probably in the long run the best returns.
From the U.S., we hear a number of people are calling a top in both the Dow and the S&P. Are these markets claiming a wall of worry, and are you bullish or bearish going forward?
Well, I'm very negative about the global economy and about people's standards of living. In other words, I believe that the typical household in the U.S., in Canada, and in most countries is not going to increase much over the next 10, 20 years. In fact, in the Western world, where I would include Japan, in other words, Western Europe, the U.S. and Japan, I think that standards of living have only one way to go, and this is down. In other words, household cost of living will increase more than the salaries. In emerging economies, the standards of living of most people is still rising, not as fast as before, but it's still rising. And concerning stock markets, we don't know how much central banks will print. You understand? There is no currency war. This is a great nonsense that has been told the world, that there is a currency war. The central banks, the major central banks, the Federal Reserve, the Bank of Japan, the ECB, the Bank of England, they all coordinate their monetary policies. They talk to each other every day. They attend the same conferences all the time, and so forth and so on. And as Kuroda of the Bank of Japan said, there is basically no limit to money printing. So they can print money endlessly, and then asset prices at the present time, notably equity prices, will go up. I happen to think that precious metal prices will go up more than equity prices. But with money printing, something will go up. It doesn't mean that the standards of living of people will go up, but some assets will go up in price.
Where do you see the bond market and interest rates heading, and is the Fed likely to raise rates in 2016?
Well, the Fed has been pursuing an expansionary monetary policy essentially since the late 1990s. They first bailed out LTCM in 1998, and then after Nasdaq bubble burst, they printed money, and it created the housing bubble, as well as in Canada. And then this housing bubble came to an end against the expectations, of course, of the Fed, that has an incredible ability not to foresee what will happen in the future. The worst forecasters you can imagine. Anyway, the crisis in 2008, 2009 happened, and then they implemented QE1, QE2, and then Operation Twist, and QE3, and then the other central banks kicked in with all kinds of monetary inflation. So the balance sheets of central banks has increased dramatically around the world. And my sense is that, of course, it will end badly, but we don't know exactly at what point it will end badly.
What will be the symptoms to look for if it is ending badly?
Well, I suppose that before the stock market collapses, there will be very negative technical signals. Now, we have some technical signals that are negative. So whereas the S&P made a new high, the Dow Jones Transportation didn't make a new high, the Dow Jones Utilities didn't make a new high, and the list of 12 months new highs did not expand dramatically. So these are symptoms that not everything is well, and earnings are going down, the economy is slowing down visibly, but stocks keep on essentially rising. So we don't know exactly at what stage the money printing will no longer work, but it's very clear that one day it won't work, and we're not sure if stocks go down, whether they go down in nominal terms. In theory, you could have money printing and all stock markets go up, but in real terms they go down. Now, what is real terms? If all central banks around the world print money at the same time, or more or less at the same time, there's no currency that will collapse against another meaningfully. So the currency exchange rate may not change all that much. But where gold and silver and platinum come in is that when they really print money like no tomorrow, people may still hold some shares like I do, but they may increasingly, as a hedge, invest in precious metals.
Are you bullish or bearish on the U.S. dollar?
I don't think there are any fundamentals that would justify a positive view about the U.S. dollar in the long run. Having said that, as I just explained, the other currencies are not much better. So if the Fed prints and then they stop printing and then the ECB prints and the BOJ prints and so on, they're passing on each other's baton. And I'm not sure where the dollar will be in a year's time, but under current central banks' monetary policies, I would suggest that to own some precious metals and more speculatively to own precious metal shares, you know, it's gold miners, silver miners, platinum miners, would be desirable.
Does the U.S. dollar need to be in a bear market to enable gold and silver to be in a major bull market?
No, in theory, the U.S. dollar could go up against the euro because the euro would be that much worse of a currency, and gold could still rally in theory. It's more likely that the precious metals prices will rise substantially if the dollar weakens against other currencies. But we don't know exactly what will happen. All I can say is money printing at the current rate and actually the balance sheet expansion of the major central banks has actually accelerated. Not the U.S. that is at the present time buying assets, but the ECB and the BOJ. But I would expect the Fed to kick in, and I don't expect any interest rate increases for the next 6 to 12 months.
Is there a shortage of physical gold and silver?
That I don't know. I suppose, say you and I want to buy gold, and buy physical gold, we can buy that gold. There's no problem. But the price may be a bit higher. There may be a premium to pay for gold. But a shortage doesn't really exist at the present time. The paper market has always been larger than the physical market. So, as you know, most future contracts, they don't lead to exercising these future contracts, but actually they lead to suppressing to some extent the physical gold market, but not in the long run, because as I said, at the end of the month, future contracts are offset. The shorts, they cover, and the longs cover, so it doesn't have that much of an impact on the price.
We'll have more with Dr. Marc Faber next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Dr. Marc Faber from Thailand. His website, gloomboomdoom.com. Doctor, if I was going to hold gold and silver, is a paper certificate enough, or should I actually physically possess it?
You asked me earlier if there was a shortage in physical gold. I think there are different types of gold certificates. I think some are fully backed by gold. In other words, if say you buy a Sprott, physical trust, an ETF, platinum, silver, gold, I think the gold is being stored in a safe deposit box in a bank. But I am not sure that all ETFs have that gold. That I also wonder.
There are predictions of gold hitting perhaps $10,000 an ounce and silver hitting between $10 and $1,000 an ounce. Your thoughts on that?
Yes, I think I answered this question already partially when I said it all depends on how much money the central bank will print. I happen to believe that central bankers know no limit. In other words, they embark on a experiment, money printing, on a global scale. So far, it's kind of failed to revive the global economy, but it boosted asset prices, and I think they'll continue to go down the road of printing money. And therefore, I don't know whether gold eventually will go to $5,000 or $10,000 or $1 million. If you look at, say, Zimbabwe, in Zimbabwe, probably an ounce of gold is worth many $1 trillion in their local currency. And so these questions are very difficult to answer because we don't know how far they will go and how far they can go. At some stage, as I say, it won't work because interest rates will go through the roof. But you understand, if interest rates go up through market forces, then the central banks can buy all the bonds. And if the stock market goes down, they can buy all the outstanding shares. If you can print money, you can print an unlimited amount of money. And so it's not possible for me to tell you where gold will go. All I can say is, in my opinion, gold and silver and platinum will go up more than equity prices, will provide you with a higher return than bonds, which have in most countries the lowest yield ever. And so I don't see much upside potential for either stocks or bonds. I have real estate, and real estate should be a hedge, and I believe it will be a hedge. But in a catastrophe, it may not protect you all that much, because before the end game ends, the governments will say, well, why is everything so bad? It's so bad because they are rich people, and they own the real estate, and they own the gold and so forth. We have to tax them. And then the taxation on real estate will go up. That's the easiest to tax. And maybe if gold prices keep on going up, the government will say, well, we have to take the gold away, and so forth and so on. You understand? These are things we don't know. I never thought in my life, when I started to work in 1970, that central banks would push down interest rates into negative territory. I never thought in my life that in democratically elected governments, so much power would be given to central bankers, most of which have never worked in a business in their lives. They're academics. Why would I, if I own a company, why would I let a university professor or an academic run the company? I want someone with practical experience.
I was going to say, so many of these people making economic decisions probably couldn't tell you the price of a loaf of bread or a liter of milk.
Most of central bankers are clueless people. We have precise statistics going back more than 20 years about their forecasts. All have been far too optimistic. None of these academics has ever predicted a recession. None of them predicted the 2008 financial crisis. But somewhere, somehow, they have all this power. And I tell you why. The financial sector, which is a very important industry nowadays, it wasn't important in the 60s and 70s as a percent of the economy, but we have monetized the world. And so the financial sector has become very important, and the financial sector loves, and I repeat, loves money printing, because with money printing, asset prices go up, and the fees for managers of funds and for advisors and brokers all go up. And for the hedge funds, unless assets go up, they have no performance fees. So everybody is applauding the Federal Reserve printing of money. It's like you have negative economic statistics coming out, the market doesn't go down, it goes up, because the financial sector thinks, negative economic statistics, the Fed will not increase interest rates, and eventually, if statistics turn very negative, they will implement QE4. We are in a totally distorted market. We are in a totally mispriced world. The other day, someone offered me 10 years bonds of Glencore in euros at 2%. Now, why would I invest in a company that is not all that solid? You know, it's not that the money is guaranteed to come back. There's a risk, there's a credit risk, and I only get 2%. Why would I do that? But compared to zero interest rates, 2% is quite good.
Getting back to the gold and silver miners, which ones would you like now? The majors, mid-tier companies, or the juniors?
Well, I think that in this rally, we had since the end of last year, actually, a lot of gold shares bottomed out already last October. You know, it was almost a year ago, and then some in December. And since then, some stocks have gone up 300%, and some maybe 200%, and some maybe only 100%. Say the GDX is up maybe a bit more than 100%. And so forth. It's difficult to tell what is more attractive, because you look at some of the majors like Barrick. There was a risk that they would go bust a year ago. So the stock became very cheap. So since then it's rallied essentially 3 times, almost 4 times at the peak. And juniors have of course also rallied, because as the price of gold went up, some of the projects are again possibly profitable. Not guaranteed, but possibly profitable. So both the juniors and the major miners are going up. I'd say on the safer side is to own the physical. That's what I always maintained. On the more speculative side, the majors are likely to go down less than the juniors if there is a setback, for the simple reason that major institutions like Fidelity and so forth, they will find it difficult to buy the really junior gold shares. So if you want to allocate, say, $1 billion to the gold sector, you have to buy the majors. But in my view, for a foreseeable future, next 1, 2, 3 years, for sure they'll print more money. They have no option. They have no option. You look at the underfunded pension fund liabilities. If the stock market goes down, all these pension funds have deep problems. They're already underfunded massively. If shares go down, if real estate goes down, they're even more underfunded. So the government has huge fiscal deficits. They have to print money. There's no alternative for them. I'm not saying this is the right way to do things, but I'm saying from their perspective of academics, they'll continue to do it.
Are any of the global banks in enough trouble to take the stock market down with them?
Possibly, but the major banks are probably, as has been said many times, too big to fail. And so governments and central banks can intervene and essentially, as they've done in 2008, had they not bailed out AIG, Goldman Sachs would also have gone bust. So they can bail out stuff. If you have the power to print money, you're the most powerful man in the world. I'm not saying this is good. I said to you before, I can't understand that so much power has been transferred to the central bankers.
Global unrest is on the rise. Will this propel volatile moves in the markets, and which markets could benefit the most from that?
Well, I think that obviously the people around the world in Western democracies and in Japan, they gradually realize that their democratically elected governments actually do not represent their interests. They represent the bureaucracy's interests, the system's interests, the elite's interests. We've seen that with Brexit, where the media and the establishment all said that disaster will happen and this and that, and ordinary people eventually voted against them. And of course, it had a negative impact on the currency, but the currency was overvalued before and would have gone down regardless. And until now, it rather looks like the British economy is doing quite well, because people feel happy to be no longer part of the EU. And so, yes, there will be unrest, there will be terrorism. The worst outcome would be if Hillary Clinton is elected, because she's a hardliner. And the reason so many Republicans support her, and people like the Bush family and so forth, the old establishment, is that she probably made a deal and said, okay, I look after domestic issues and health care and all this, and you, the neocons, you look after foreign policy. Unfortunately, the U.S. is not the powerful country relative, and I'm speaking here relative to the rest of the world, it was in the 50s and 60s. And now they have other people coming up. Some have economic problems, I admit. But nevertheless, the U.S. can no longer go and teach China about anything. China is an important economy. It is an important geopolitical power. It has capital. Nor can the U.S. go and give lessons to Putin. So we have now gone from a unipolar world to a multipolar world, where other powers have come up and certainly eroded the hegemony of the U.S. on the world stage. It's probably the U.S. is still probably the world power in terms of military. But are they the world power in terms of military in Asia? Are they the world power in terms of military in Central Asia, in the Middle East, in Ukraine? That I have some reservations about. And so, yes, there will be more volatility. But if you really are worried about geopolitical developments, the compelling asset to own are precious metals.
Is India going to surpass China as the world's biggest economy in the long run?
Yes. India has, over the last 30, 40 years, developed at a much slower pace than China. There's no question about it. If you go to China, the infrastructure is built to a large extent. The country GDP per capita wise is much higher than India. Oil consumption per capita is much higher than India. Exports are much higher than China, than India, and so forth and so on. But I think that India could pick up relative to the rest of the world. And then there are some debates about India. Will it grow at 7 or 9%? In my view, it doesn't matter. I happen to think that India, if they are doing very well, they will grow at around 4 or 5%. But 4 or 5% per annum is a huge growth rate in the long run. And Indian companies, by and large, are well run, and they are more transparent than Chinese companies. So yeah, I believe that India is an upcoming country, but of course I wouldn't put all my money into India, but there are opportunities in India for sure.
Dr. Faber, thank you very much for being on This Week in Money.
Thank you very much.
My guest has been Dr. Marc Faber. His website, gloomboomdoom.com. He was speaking to us from Thailand. Coming up, Mackey Research's Payton Nyquvest next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
We're chatting with Payton Nyquvest. He's an investment advisor at MackeyResearch.com. Payton, what happened on the Canadian junior markets this past week?
This week on the TSX Venture, the high was 801.46, which was actually the low for the week, and it closed at 812.16, so up about 11 points for the week. The Canadian Stock Exchange was at a high of 675.88 with a low of 665. Closed at 666.85, which is down about 10 points for the week as well. So the leading sectors and most active traders on the venture, mining continued to lead the way, and most active were Newgate Legacy Gold, Noront, and Nicola Mining, where on the CSE, the most active traders were actually in the marijuana sector. Stocks were Aurora Cannabis, Puff, and THC. So it's actually been interesting. The marijuana stocks on the venture and on the CSE seem to be getting quite a lot of activity here in the last little bit. Probably the most busy they've been since that sector emerged a couple of years ago, and have seen quite a lot of money flow to that area here in the last couple months. And outside the mining space, the zinc companies have also seen a lot of activity in the last little bit, led primarily by Arizona Mining, which is run by Richard Warwick, which pushed through new highs of over $2.40 a share, as it had drilled some of the best holes to date on its Hermosa property. And the feeling on the street seems to be that zinc will probably be the next big thing in the resource market, whereas a lot of the lithium stocks have been fairly quiet this past week as well.
One of the reasons why zinc would be so hot, I would imagine, is that the world's three biggest zinc mines are shutting down.
Yeah, exactly. They're starting to see quite a supply issue there, and zinc prices have climbed quite a bit in the last little bit as well. So
now, of course, all the talk about new batteries is lithium, but I don't think you can build a battery without zinc, can you?
No, zinc's a component of that as well, so there'll definitely be kind of some spillover from the hype around the lithium space into the zinc market.
Is there much chat about getting lithium from old oil wells? I know they're looking at that in Alberta.
There's been a few companies, MGX being one of the leading companies that have spent quite a bit of time and effort in the last couple of months looking at the process for extracting lithium out of oil wells. Finding lithium isn't overly difficult. What seems to be the real secret is figuring out a proper extraction and producing technique for getting lithium out of the ground at a cost-effective price.
I've also heard there's new technology for discovering gold that's dissolved in water.
I actually haven't heard too much about that. I know that there's been some pretty creative companies out there doing different things in terms of extracting gold. There was a company the other day that is actually taking old keyboards and other technology or different technology wastes and essentially mining them for gold out of their parts.
Payton, I understand some new regulations have also kicked in the junior mining business.
More so than just the junior mining business, but across the TSX Venture and the CSC, there was a few different initiatives that got changed, I'd say, within the last 6 months that you're now kind of starting to see come into effect. The first one was being able to do 10-for-1 rollbacks without shareholder approval. The point in this is companies need to be able to go out and restructure themselves and have a chance at life again, and being able to go and do a 10-for-1 rollback without shareholder approval gets them to be able to speed up the process without having to call a shareholder meeting, which costs money and a bunch of time. Typically, if a company's in a position where it needs a 10-for-1 rollback anyway, anybody who's still a shareholder is fine to have that happen. And then the fairest way to go and deal with those shareholders and give them a fair opportunity to participate in that company still, they've gone out and made some changes to the rights issues. So the rights issues used to be a very expensive, north of $200,000 financing mechanism that had a huge, probably 50-page document that would have to go get sent out to every shareholder and was quite an undertaking. So they've now changed that. The average rights issue cost about $30,000 to the company, and it's just a one-page document that gets sent out. So it's very easy for shareholders to be able to participate in these rights issues, or if they don't want to participate, there's an opportunity for people who would like to be shareholders to actually go in and subscribe for those rights if the shareholders decide that they don't want to participate in the rights issue.
Have these changes been welcome? I know we've done several shows here on This Week in Money about how people felt the Canadian junior markets and the equity markets in general were just bogged down with too much red tape. Have these changes helped?
I think you've seen the pendulum swing the other way here now. It's taking some time. But you're starting to see a couple of these rights issues start. MGX Minerals is one that's going through the process right now, and it's been, I think, quite popular. They've seen a lot of shareholders be interested in how it all works. They have a right that trades, which is actually seeing quite a lot of volume. So I think it's starting to work, and as they continue to roll out here, especially with the picked up activity in the venture market, I think you're going to see that continue.
I know in the past people complained that certain categories of people weren't allowed to invest. If you were 65, for example, and didn't have $1 million or more in assets outside of your home, you weren't allowed to participate. Has that changed for the junior markets?
Sure. So what you're able to do now is if you want to do a financing that is not with accredited investors, a company can now go and apply for that. The participants of the financing have to do the financing through a brokerage firm. So essentially the broker who the client is taking the financing through is essentially, through their know their client rules, ticking off the box saying that they are saying that this person is a worthy candidate, so to speak, of being able to take that financing.
Were those old regulations overly protective? I noticed there's no warning sign on a casino saying if you don't have $1 million, don't step inside.
Well, that's kind of been the argument, right? Is I can go to a casino as an 18-year-old with no money and go and blow whatever I've got, but I can't go and try and make educated decisions in the market. So that's been a large part of it. There's also the opinion of who are, if a client is 70 years old and wants to take a financing, who are we to tell them how to spend their money? At the end of the day, it should be up to the client how they want to dispose of their capital.
Payton, thanks for chatting with us.
Perfect. Thanks for having me.
My guest has been Payton Nyquvest, investment advisor at MackeyResearch.com. We'd like to thank our guests, Ross Clark, Dr. Marc Faber, and Payton Nyquvest, and thank you for listening. Questions for the show could be emailed to info@howstreet.com. I'm Jim Goddard.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.